You can buy something and still not own it. Millions of people just discovered that. Most of them don't know it yet. $75 billion, the biggest IPO in history, a chain of mergers where one man sat on every side. A question nobody thought to ask until it was too late, and a system now spreading across corporate America. So let's follow the money. It's October 2022. A man walks through the front doors of a social media company in San Francisco. He's carrying a kitchen sink. He posts a video. Caption, "Let that sink in." He'd already put humans in orbit, built the most valuable rocket company in history, turned a $100 million bet on electric cars into a $1 trillion company. He was the richest person on earth, and he'd just closed a deal he tried to walk away from. That sink, it wasn't a joke, it was the first move in a system nobody was supposed to see, one that would change what it means to own a piece of a company, and one that would rewrite the rules for every investor in America. This is how that system was built, step by step, merger by merger, and what it means for anyone buying stock today. But to understand the system, you have to understand the deal that started it. April 2022, Elon Musk offered to buy Twitter, $44 billion. The board said yes. Then Musk changed his mind, said the platform had too many fake accounts. Twitter sued to force the deal and won. On October 27th, he walked through the doors, sink in hand. The deal was done. What happened next was fast. He cut 75% of the staff in a single week. Engineers, moderators, trust and safety teams, gone. He rolled back content rules, changed the name to X, and the advertisers, they pulled out one by one, then all at once in 2021. The platform brought in $4.5 billion in ad revenue. By 2025, $1.8 billion, less than half, in 4 years. And the investors who'd helped fund the deal, the people who wrote checks because Musk asked them to, they watched their money shrink. Fidelity marked down its stake by 65%, one of the biggest investment firms in the world, writing off the deal. The company Musk paid $44 billion for was now worth roughly $9 billion. And these weren't just Wall Street bets. Somewhere in a state pension office, a fund manager watched the value drop by 2/3 on a screen. Money earmarked for teachers' retirements, firefighters' pensions. Larry Ellison wrote a check. So did the Saudi royal family, Andreessen Horowitz, the biggest names in finance and the quietest. All of them watching billions shrink every quarter. Money that was supposed to grow, doing the opposite. No buyer willing to step in, no public market to sell into, no exit. Just a company losing value, controlled by a man who showed no interest in slowing down. Now in most stories, this is where it ends. Bad deal, lessons learned, move on. But here's what most people missed. $44 billion doesn't just vanish. The value didn't disappear. It didn't evaporate into nothing. It was sitting there, inside a company Musk still controlled. And when you control the container, you can decide where the losses go next. Because losses don't have to stay losses. Not if you can create a new container, move the value over, attach a new label, and rewrite the number. That's exactly what happened. In 2023, Musk launched a new company, called it XAI, an artificial intelligence lab, built to compete with OpenAI. Within a year, investors had put in $12 billion. Valuation, $80 billion. The AI gold rush was on, and then he made his move. In March 2025, XAI acquired X, the platform formerly known as Twitter, all stock, no cash. The deal valued X at $33 billion. Stop and think about that. A platform worth $9 billion in 2024, suddenly valued at $33 billion in 2025. Not because it recovered, not because revenue came back, because it was being bought by another company Musk controlled. Now think about who was involved in this deal. The buyer was Elon Musk. The seller was also Elon Musk. The person who set the price, Elon Musk. The person who approved the price, Elon Musk. One person, on both sides of the table, No auction, no outside bidder, no independent market deciding what X was worth. Just one man, moving an asset from one pocket to the other, and writing the number himself. In almost any other situation, that would raise serious questions. But when you're the richest person on earth, building the rockets governments depend on, those questions tend to get asked very quietly, if they get asked at all. And those investors, the ones locked inside Twitter at 65% losses, their shares were converted into XAI stock. Same money, new container, bigger number. But that wasn't the system. That was just the first transfer. The second one came fast. On February 2nd, 2026, SpaceX announced it was acquiring XAI, all stock. Again, no cash. Again. The deal valued the combined company at $1.25 trillion, the largest private merger in history, not just in tech, in any industry, ever. Now follow the chain. Twitter shares became XAI shares in 2025. XAI shares became SpaceX shares in 2026. The investors staring at 71% losses were now holding stock in the most valuable private company on earth, at a valuation 3 times higher than when they first got converted. 2 mergers, zero cash, 3 companies into one, and the value that was lost inside Twitter, it traveled through 2 containers and came out looking like a completely different asset. The losses didn't disappear. They changed shape, changed name, changed wrapper, but the trail is still there, if you know where to look. And here's the part people miss about this chain. At no point did an outside market set the price. No independent buyer stepped in. No open auction determined the value. Every number was decided internally by entities controlled by the same person. The numbers went up, but the mechanism behind them was the decision of one man. Now here's the thing. The chain wasn't the system. The chain was the setup, the architecture, the foundation for what came next. And what came next had nothing to do with mergers. It had to do with a question most people never think to ask. When a company goes public, what does ownership actually mean? On May 20th, 2026, SpaceX filed its S1. For the first time ever, the public could see what was actually inside this company. And what they found wasn't a rocket company, it was 3 businesses, stitched together, presented under one name, the Rockets, $4 billion in revenue, barely breaking even. The business that put SpaceX on the map wasn't the one making money. The AI division, XAI, Grok, the platform formerly known as Twitter, $6.35 billion in operating losses in a single year. The newest piece of the company was bleeding cash faster than anything else. And then there was Starlink, the satellite internet network, 10 million subscribers, 164 countries, 11.4 billion in revenue, 4.4 billion in operating profit, one division, carrying the entire empire on its back. Now here's the thing. Starlink's profits weren't going to shareholders. They weren't funding the next Mars mission. They weren't building the next generation of rockets. They were being funneled into a $6 billion AI loss and a social media platform, pulling in less than half the revenue it once did. One division making all the money, the other two burning through it. And every dollar of Starlink profit that went to cover those losses was a dollar that didn't go back to the people who invested, didn't go to dividends, didn't go to the bottom line. It went to fund a bet, one person's bet, placed with other people's money. On June 12th, the entire package went public. $75 billion raised, the largest IPO in the history of stock markets, 4 times oversubscribed. Sovereign wealth funds from Saudi Arabia and Kuwait piled in. Retail investors bought through Robinhood and Fidelity and Schwab. The stock climbed all day. Musk's stake alone was worth over $760 billion. Add Tesla, and his net worth crossed $1 trillion. The world's first trillionaire, worth more than the next 5 richest people combined. more than the entire GDP of Sweden. The headlines celebrated, the markets cheered. Millions of people opened their brokerage apps and saw the letters SPCX in their portfolios. But while the world was talking about the number, nobody was asking the question that actually matters. $75 billion walked through the door. What did it buy? It bought shares. It bought a claim on future profits. It bought a line in a brokerage account. But it didn't buy the one thing that makes ownership mean something: the power to decide. SpaceX went public with a dual class share structure, two types of stock: Class A for the public, Class B for Musk. The difference? Class B carries 10 times the voting power. So while Musk holds 12% of the Class A shares, he controls 85% of all votes. 12 and 85. Those two numbers tell the entire story. The public put in $75 billion and got stock with a fraction of the voting rights. $75 billion entered the company. Not a single vote changed hands. If you bought shares on that day, your money is now inside that system. Your dollars fund whichever division one person chooses. Your investment goes wherever he decides. And your shares, they carry a fraction of the voting power of his. You bought ownership. He kept control. Every decision, board seats, acquisitions, strategy, compensation, where the money goes, how it comes back, all of it. If Musk wants to buy another company tomorrow, shareholders can't stop it, can't even vote on it. The prospectus says it in plain language. SpaceX is a controlled company, exempt from standard governance requirements, and that power isn't theoretical. It's already been used. The XAI acquisition happened under this structure. A money-losing AI lab, a declining social media platform folded into SpaceX, no public vote, no shareholder approval. One person decided where billions would go. The people funding the company had no say. Think about the full chain: the Twitter deal, the XAI merger, the SpaceX merger, the IPO. At every single step, one person made the decision. And now that it's public, the $75 billion that walked through the door still doesn't change that. That means if Musk decides Starlink profits should fund AI, that's his call. Shareholders don't vote on it. If he decides to buy another company and fold it into SpaceX, nobody can block it. If he changes the entire direction of the company, the millions of people who own shares will find out when everyone else does. Here's your dinner party line. You can invest in the most valuable company ever to go public. You can own a piece of the rockets and the satellites and the AI. But you can't remove a single board member. You can't challenge a single acquisition. You can't influence how your money gets spent. The ownership is yours. The control isn't. And here's where this story stops being about one company, one person, one IPO. Because SpaceX isn't the exception, it's the preview. Zuckerberg controls Meta the same way, not because he owns the most shares, because he holds a class of stock with extra voting power. 3 billion people use his platforms. The public funds the company. Zuckerberg makes every decision. Same model, same result. Google's founders, same thing. Page and Brin still control Alphabet, years after stepping away from daily operations. Their voting power didn't leave with them. And then there's Snap. When Snapchat went public, the shares they sold carried zero voting rights, not reduced, zero. The company put it in the prospectus. Most people bought anyway. Each time it happens, the structure gets a little more extreme, a little more tilted. The founders keep more, the public gets less, and nobody stops it, because the stocks keep going up. That's the part nobody talks about. When the stock goes up, nobody asks who holds the power. Nobody reads the fine print. Nobody checks how many votes their shares actually carry. The returns feel like proof the system works, proof that founders should keep control, until the day the returns stop, and the shareholders realize they never had a voice to begin with. Now, to be fair, there's a case for this model. Dual-class shares protect founders from short-term pressure. They let companies make bold bets. Google and Meta have delivered enormous returns, even without meaningful shareholder input. But the question isn't whether the system works when the founder is right. The question is what happens when they're wrong, and who pays for the mistake. Because the entire structure of public markets rests on one assumption, one idea so fundamental, most people forget it's even there. That shareholders hold companies accountable, that ownership comes with a voice, that the people who fund the company can change its direction if something goes wrong. What happens when that mechanism is gone? When capital flows in one direction and power stays in another? When owning stock means nothing more than exposure without influence? That's not a SpaceX question. That's a question about what ownership means, what accountability means, and whether buying a share of something still means what we think it does. Remember that sink? The one a man carried through the doors of a social media company in October 2022? The deal everyone called a disaster, the $44 billion joke. That wasn't a joke, and looking back, it wasn't really a mistake. It was the first move in a chain of moves. Each one, all stock, no cash, same person on every side of every deal, carrying value from one container to the next until the losses changed shape. The company went public and $75 billion walked through the door. But here's the part most people still don't see. The public showed up. They bought the shares, they bought the ownership, but not the control. The control stayed where it started, in the hands of one person, with 85% of the votes and 12% of the shares. And that's the system, not the rockets, not the mergers, not the $1 trillion fortune, not even the man at the center of it. The system is simpler than all of that, and older, and it's growing faster than anyone expected. You can buy something and still not own it. The public provides the money, the founder keeps the power. Ownership goes in one direction, control stays in another, and the gap between the two grows wider every year. Right now, every major tech founder in America is watching this, learning from it, building the same structure into their own companies, brick by brick, IPO by IPO. And the next time you open a brokerage app and buy a share of anything, ask yourself one question. What am I actually buying? Ownership or just exposure? Because the answer to that question is changing and most people haven't noticed yet. That's the trail, that's the system, and now you've seen it. Follow the money, see the system. If you like this video, subscribe to Magnifico Mint and hit that like button.